On August 1st, 2012, at 9:30 in the morning, Knight Capital opened for trading. By 10:15, the firm had lost more than $460 million. Just 45 minutes. Case File 01, Knight Capital. Knight was a top 10 market maker in the US. That morning, a piece of dormant code, switched off since 2003, was accidentally switched back on. This is how it caught up with them. Knight ran on an automated system called SMARS. Its job was to take clients' large orders, break them into thousands of smaller ones, and fire them into the market in fractions of a second. On a normal day, SMARS alone moved 1 in every 100 shares traded in America. It ran across 8 servers. That summer, the New York Stock Exchange launched a new program for retail investors. To take part, every firm had to update its software, Knight included, so Knight's engineers rewrote part of SMARS. And to save time, they did something small and ordinary. They reused an old on-off switch buried in the code which years earlier had controlled a function called PowerPeg. PowerPeg was dead code, switched off back in 2003. Nobody at Knight had used it since, but nobody had deleted it either. It was still sitting on all 8 servers, waiting for something to flip that switch back on. And there was a second flaw, one no one remembered. Back in 2005, Knight had quietly moved one piece out of PowerPeg, the counter that tracked when an order was finished, the part that knew when to stop. Nobody retested PowerPeg after that. Why would they? It was dead code. On July 27, 2012, Knight began rolling out the new code, 1 server at a time on consecutive days, 8 servers in total. On the final day of the deployment, a technician missed a server. Knight had no written procedure requiring a second engineer to check. The SEC's order put it this way: Knight did not have a second technician review this deployment. No one at Knight realized that the PowerPeg code had not been removed from the 8th server, nor the new RLP code added. 7 servers had the new code, the 8th still ran the old code. Including the dormant PowerPeg, 2 different versions of the system were now live. Depending on which server processed your order, the same switch meant 2 different things. On August 1st, the morning began quietly. The market open was still 90 minutes away. At 8:01 in the morning, orders started to flow in. They were eligible for the new retail liquidity program, but they were flagged for pre-market trading. 7 of the 8 servers handled them correctly. The 8th interpreted the switch as something else entirely. On server number 8, the switch triggered PowerPeg. PowerPeg started routing child orders exactly as it had been designed to in 2003. But its stop when filled counter had been moved out of the function 7 years earlier. So the counter never reset. The orders never stopped. Knight's own systems flagged the problem in real time. Starting at 8:01 in the morning, an internal alerting system began sending automated emails. They referenced SMARS. They identified the error. Subject line: PowerPeg disabled. By 9:30, 97 of those emails had gone out, each to a group of Knight personnel, the SEC again. Knight did not design these types of messages to be system alerts, and Knight personnel generally did not review them when they were received. None of the 97 were treated as alerts. None of them were read before the market opened. At 9:30 on August 1st, the market opened. On server number 8, 212 customer parent orders began running through the broken code. SMARS started sending millions of child orders, in rapid sequence, for each parent order, without regard to whether the parent orders were already filled. One part of Knight's order handling system did recognize that the parent orders were complete. That information was never communicated to SMARS. Within minutes, traders across Wall Street saw something wrong. Stock prices in dozens of companies were moving without news and without reason. The New York Stock Exchange traced the volume back to Knight and called Knight's chief information officer. Knight's technology team scrambled, but the firm had no playbook for moments like this. The SEC stated it flatly. Knight did not have supervisory procedures concerning incident response. For the next 20 minutes or so, the team tried to figure out which system was firing the orders. Then someone made a decision. They concluded the new code was the problem. They uninstalled the new retail liquidity program code from the 7 servers where it had been deployed correctly. This was the wrong call. Removing the new code meant the switch that had triggered PowerPeg on server 8 now triggered it on the other 7 too. Knight had just spread the bug to its entire SMARS infrastructure. Meanwhile, the runaway algorithm kept sending orders: 4 million executions, 154 stocks, 397 million shares. In 75 of those stocks, Knight became more than 20% of the trading volume. In 37 of them, prices moved more than 10%. By the time the kill switch was thrown at approximately 10:15 in the morning, 45 minutes after the open, Knight had taken on a net long position of $3.5 billion in 80 stocks, and a net short position of $3.15 billion in another 74. That afternoon, Goldman Sachs agreed to buy the entire portfolio off Knight's hands, as a single basket trade. At a discount, the runaway was now Goldman's problem. Knight had a $460 million bill to pay. The next morning, August 2nd, Knight put out a press release. The language was careful. A loss of about $440 million, they said. Full compliance with their capital requirements. And clients were not negatively affected. 14 months later, the Securities and Exchange Commission told a different story. The loss was over $460 million, and the firm had been left with, in the Commission's words, significant net capital problems. The market had already passed its own verdict. 2 weeks earlier, Knight's stock had traded above $12. Within days of the glitch, it was worth $2.70. Knight was now too weak to survive alone. Within days, a group of investors stepped in with $400 million to keep the firm breathing, and took about 70% of it in return. The New York Stock Exchange quietly handed Knight's market-making duties to another firm. The exchange had stopped trusting them. Less than a year later, Knight Capital merged with a trading firm called Getco and vanished into a new company, KCG. Its independence was over. As for the regulator, the SEC found Knight had broken the market access rule, the rule written to stop exactly this. The penalty was $12 million, against a $460 million loss. And the SEC named no one, not the technician who missed the server, not the executives who pulled the wrong code. The order refers to them only by their job titles. On July 27, 2012, a single technician failed to copy one piece of code to one of 8 servers. On August 1st, that one missing piece of code cost Knight Capital its independence. The market access rule, in the SEC's own words, requires that brokers, as gatekeepers to the financial markets, appropriately control the risks associated with market access, so as not to jeopardize their own financial condition, that of other market participants, the integrity of trading on the securities markets, and the stability of the financial system. This was Case File 1. This was Court.